across the United States. The rental market is no longer moving in one direction. After years of relentless rent growth, certain cities are now experiencing measurable, sustained declines. This is not seasonal softness. It is not a minor correction. In several major metro areas, rents are falling sharply. Concessions are surging, vacancy rates are climbing, and landlords are adjusting expectations in real time. Today, we're counting down 10 U.S. cities where local rent is collapsing and landlords are under serious pressure. This ranking is based on recent rent trends, supply pipelines, population shifts, vacancy data, and investor behavior. What unfolding in these markets could shape housing conditions nationwide over the next several years. If you value data-driven housing analysis without hype or speculation, take a moment to like this video, subscribe to the channel, and turn on notifications. We break down housing trends with context and evidence, not headlines. Midway through, I'll explain what this shift means for both renters and property investors heading into the next 12 to 24 months, and why the pressure may not be over. Let's begin the countdown. Number 10, Phoenix. Phoenix was once the poster city for explosive rent growth. Between 2020 and 2022, the metro experienced some of the fastest rental increases in the country. Investors poured in. Institutional buyers aggressively acquired single-family homes for rental portfolios. Developers launched large-scale multifamily projects across the metro, from downtown to the West Valley. But markets that rise quickly can correct just as quickly. Today, Phoenix is dealing with the aftereffects of a historic construction surge. During the low-interest rate period, developers locked in financing for thousands of new units. Those projects are now delivering into a market where demand has normalized. The result is a supply-demand imbalance that is putting sustained downward pressure on rents. Vacancy rates have climbed above their pre-pandemic averages. Class A properties, particularly newer luxury builds, are competing intensely for tenants. Effective rents, which factor in concessions like 1 or 2 months free, are meaningfully lower than headline asking rents. In many submarkets, year-over-year rent growth has turned negative. Another factor is affordability fatigue. Phoenix rents rose far faster than local wage growth during the boom. That created a ceiling. Once that ceiling was reached, demand elasticity became visible. Tenants doubled up. Some relocated to more affordable suburbs. Others left the metro entirely as remote work flexibility allowed them to reconsider geography. Institutional single-family rental operators are also contributing to competition. When apartment landlords and rental home operators compete for the same renter pool, pricing power weakens. On the investment side, pressure is building. Many properties purchased in 2021 and 2022 were underwritten with optimistic rent growth assumptions. Those assumptions are now being revised downward. At the same time, refinancing is occurring at interest rates significantly higher than what owners initially projected. That combination, falling rents and rising debt costs, compresses margins rapidly. Phoenix is not facing economic collapse. Job growth remains present, and long-term demographic trends still favor the Sun Belt. However, the short-term imbalance is clear. Supply expanded faster than demand could sustainably absorb. Until construction slows and vacancy stabilizes, landlords in Phoenix will remain in a competitive and defensive position. Number 9, Austin. Austin's rental correction may be one of the most dramatic in the country relative to its prior surge. During the pandemic migration wave, Austin became a magnet for tech workers, remote professionals, and corporate relocations. Major employers expanded or announced new operations. Population growth accelerated. Rents climbed at historic rates. Developers responded exactly as economic theory predicts. They built aggressively. At one point, Austin had one of the largest multifamily construction pipelines in the United States relative to its population size. Thousands of units were under development simultaneously. Projects that broke ground during the peak optimism of 2021 and early 2022 are now reaching completion. But demand has cooled from extraordinary to normal. Year-over-year rent declines in Austin have been among the steepest nationally. In some submarkets, effective rents are down double digits from peak levels once concessions are included. Landlords are offering extended free rent promotions, parking incentives, reduced deposits, and flexible lease structures to maintain occupancy targets. Vacancy rates have risen significantly compared to the ultra-tight conditions seen during the boom. The imbalance is especially pronounced in Class A urban properties, where supply concentration is highest. Another layer of complexity is investor exposure. Austin attracted substantial institutional capital, from private equity to REIT-backed operators. Many acquisitions were priced at compressed cap rates based on the assumption of continued rapid rent growth. Now, with rents declining and interest rates elevated, asset valuations are being reassessed. The tech sector slowdown also plays a role. While Austin remains a major innovation hub, hiring growth has moderated compared to the pandemic-era expansion. Demand tied to rapid corporate scaling has cooled. Importantly, Austin's long-term fundamentals remain strong. Educated workforce, business-friendly policies, lifestyle appeal. But rental markets operate in cycles, and Austin is currently working through one of the largest supply waves in its history. The correction is not a crash, but it is significant. It will likely take multiple leasing seasons for absorption to catch up with deliveries. Until then, landlords must compete on price, incentives, and flexibility. Austin's experience is a textbook example of how rapid growth, when paired with aggressive construction and changing macroeconomic conditions, can shift a market from landlord-dominated to renter-favorable in a remarkably short period of time. Number 8. Las Vegas. Las Vegas has always been one of the most cyclical housing markets in the United States. Its economy is heavily tied to tourism, hospitality, conventions, and discretionary consumer spending. That makes it sensitive to broader economic slowdowns. However, the current rental correction in Las Vegas is less about economic collapse and more about structural imbalance. During the 2020 to 2022 housing surge, Las Vegas experienced strong inbound migration, particularly from higher-cost states like California. Investors followed that migration. Single-family homes were purchased in large numbers to convert into rentals. Multifamily developers accelerated new apartment projects, betting that population growth would remain elevated for years. But demand growth has normalized, while supply has not. Thousands of new apartment units have been delivered across the metro area in a relatively compressed time frame. When that much inventory hits the market simultaneously, it creates competitive pressure. Vacancy rates have moved higher than their pre-pandemic lows, and landlords are responding with incentives that had largely disappeared during the boom years. In many submarkets, advertised rents are flat to declining year over year. Effective rents, after accounting for concessions such as 1 or 2 months free, are falling more sharply. Class A properties are particularly affected because they face the greatest direct competition from newly delivered buildings with modern amenities. Affordability is another constraint. Las Vegas wages have not kept pace with the rapid rent increases of the pandemic period. At some point, renters reach a financial ceiling. When that ceiling is reached, landlords cannot simply continue raising prices. Instead, they must adjust downward to match local income realities. Operating expenses are also rising. Insurance costs in Nevada have increased. Maintenance and labor costs are elevated compared to pre-pandemic norms. When rents soften while expenses climb, net operating income shrinks. That directly affects property valuations and refinancing conditions. For smaller landlords, this environment requires careful cash flow management. For larger operators, it means offering concessions and absorbing lower margins while waiting for absorption to catch up with supply. Las Vegas is not experiencing the type of collapse seen during the 2008 financial crisis. Employment levels remain relatively stable, and tourism has recovered significantly. But the rental market is clearly in a corrective phase. Until new construction slows and vacancy stabilizes, landlords will continue competing aggressively for tenants in a market that no longer guarantees easy rent growth. Number 7. Denver. Denver has long been viewed as one of the most stable and desirable rental markets in the Mountain West. Strong population growth, an expanding professional workforce, and lifestyle appeal supported steady rent appreciation for years. But like many high-growth metros, Denver significantly increased multifamily construction during the low-interest rate era. Now, That supply wave is colliding with moderating demand. Developers broke ground on a large number of projects between 2020 and 2022 when financing was inexpensive and rent growth projections were optimistic. Those units are now being delivered into a market where migration has slowed and affordability concerns are more pronounced. Vacancy rates have moved upward across multiple submarkets, particularly in newer urban developments and high-amenity properties. As vacancy rises, pricing power declines. Landlords are offering free rent periods, move-in credits, and flexible lease terms to remain competitive. In many cases, effective rents are meaningfully lower than peak 2022 levels. One structural factor in Denver is the concentration of new Class A inventory. When multiple luxury properties open within close proximity, they compete for a relatively narrow renter demographic. Higher-income households seeking premium amenities. That segment can absorb only so much supply at once. At the same time, elevated mortgage rates have created an unusual dynamic. In theory, higher homeownership costs should support rental demand. In practice, affordability pressures are impacting renters just as strongly. Wage growth has not fully kept pace with prior rent increases. Some households are choosing roommates, downsizing, or relocating to more affordable suburbs within the metro area. Operating costs in Denver have also risen. Property taxes, insurance, and maintenance expenses have increased, particularly in areas facing climate-related risks. When income declines while expenses rise, landlord margins narrow quickly. From an investment standpoint, Denver's transaction activity has slowed. Buyers are demanding higher cap rates to compensate for risk and softer rent projections. Sellers, especially those who purchase at peak valuations, are reluctant to accept lower pricing. That standoff is reducing deal volume and adding uncertainty. Importantly, Denver's long-term fundamentals remain relatively strong. The city continues to attract educated workers and diversified employers. However, rental markets operate in cycles driven by supply timing. And right now, Denver is in the absorption phase of a heavy development cycle. The correction is not dramatic enough to signal systemic distress, but it is substantial enough to shift leverage toward tenants. Until new deliveries taper off and vacancy tightens, landlords in Denver will remain in a competitive environment defined by incentives, pricing adjustments, and thinner operating margins. Number 6, Atlanta. Atlanta is one of the largest and most economically diverse metro areas in the Southeast. It benefits from logistics, film production, technology expansion, healthcare, and a growing corporate presence. For years, those fundamentals supported steady rental demand. But even strong economic foundations cannot fully offset the impact of rapid supply expansion. Over the past several years, Atlanta saw a significant acceleration in multifamily construction. Developers targeted high-growth suburbs, mixed-use urban districts, and transit-oriented developments. Financing was readily available, and rent growth during the pandemic reinforced confidence that demand would continue climbing. Now, the market is digesting that expansion. Vacancy rates have increased across several submarkets, particularly in newer Class A properties. While Atlanta is not experiencing the sharpest rent declines in the country, rent growth has slowed dramatically and in certain pockets has turned negative year over year. Effective rents are under more pressure than advertised figures suggest due to widespread concessions. Luxury and high-amenity properties face the greatest competition. When multiple new developments open within a short distance of one another, they compete for the same tenant demographic. To maintain occupancy targets, landlords are offering incentives such as 1 or 2 months free, waived application fees, and flexible lease terms. Another important factor is institutional single-family rental presence. Atlanta became a major hub for large-scale rental home operators following the last housing cycle. That means apartment landlords are not only competing against other multifamily buildings, but also against professionally managed rental homes in suburban neighborhoods. This broadens tenant choice and weakens pricing power. At the same time, operating costs are rising. Insurance premiums in parts of Georgia have increased, and property tax assessments have moved higher in certain counties. When rent growth slows but expenses continue to climb, net operating income compresses. Refinancing risk is also emerging as a concern. properties financed during periods of ultra-low interest rates are now facing higher borrowing costs. If rental income does not meet prior projections, owners may need to inject additional capital or accept lower returns. Atlanta's long-term growth story remains intact. Population gains continue, and the metro area retains economic diversity. However, in the short term, the rental market has clearly shifted from a landlord-dominated environment to a more balanced, and in some submarkets, renter-favorable landscape. This is not a collapse in the traditional sense, but it is a meaningful correction driven by excess short-term supply and affordability constraints. Until new deliveries slow and vacancy stabilizes, landlords in Atlanta will remain in a competitive environment that demands flexibility and pricing discipline. Number 5. Nashville. Nashville transformed rapidly over the past decade. Once viewed primarily as a tourism and entertainment hub, it evolved into a diversified metro area attracting healthcare companies, financial services firms, and corporate relocations. During the pandemic migration surge, Nashville became a prime destination for remote workers and out-of-state movers. Rent growth followed that migration. Between 2020 and 2022, rents increased at rates that significantly outpaced historical averages. Developers responded with confidence. Construction cranes became a common sight across the urban core and suburban growth corridors. Now, Nashville is working through the consequences of that rapid expansion. A substantial number of multifamily units have delivered within a compressed time frame. While Nashville continues to grow, demand has not expanded quickly enough to absorb the surge without friction. Vacancy rates have risen from their historic lows, particularly in newly completed properties. Luxury developments are facing the most direct pressure. High-end units with premium amenities must compete, not only with one another, but also with slightly older properties, adjusting rents downward to remain attractive. Concessions have become common, with some properties offering multiple months of free rent to maintain occupancy levels. The affordability ceiling is also visible in Nashville. Wage growth has been steady but has not kept pace with the rapid rent escalation of prior years. Renters who stretched their budgets during the boom are now more cautious. Some are renewing only if pricing remains stable or declines. Others are exploring lower-cost neighborhoods or suburban options. Another factor is investor underwriting. Many properties were financed under the assumption that Nashville's growth trajectory would continue uninterrupted. When rent growth slows or reverses, projected returns must be recalculated. Combined with higher interest rates, this dynamic tightens cash flow and reduces flexibility. Transaction activity has moderated as buyers and sellers reassess valuations. Cap rates are gradually adjusting upward, reflecting softer rent projections and higher financing costs. Importantly, Nashville's structural fundamentals remain relatively strong. The metro continues to attract businesses and residents over the long term. However, rental markets move in cycles tied closely to supply timing. And Nashville is currently in an absorption phase, following one of its largest construction waves in history. The result is not a dramatic collapse, but a measurable correction. Landlords are competing more aggressively. Tenants have greater negotiating leverage. And until the pace of new deliveries slows, rent growth is likely to remain subdued. Nashville's experience underscores a broader pattern seen across several high-growth Sunbelt markets. Rapid expansion, followed by a necessary period of stabilization where supply catches up with demand. Number 4. Tampa. Tampa has been one of the fastest-growing rental markets in Florida over the past several years. Fueled by pandemic-era migration, low interest rates, and the state's business-friendly environment, the city experienced a surge in both population and rental demand. Between 2020 and 2022, rents in Tampa rose at double-digit annual rates, with some submarkets seeing year-over-year increases of 20% or more. Developers responded aggressively. Multifamily construction soared across the metro, particularly in suburban corridors and urban infill areas. Thousands of new apartments were delivered within a short time span, creating a temporary oversupply relative to sustainable demand levels. The sheer pace of development has been a major factor in the recent softening of rents. Rents in Tampa have now flattened and, in several neighborhoods, begun to decline. Year-over-year data shows that effective rents, after factoring in concessions such as 1 month free or waive fees, have dropped, particularly in newer Class A properties. Landlords are adjusting strategies, offering incentives to attract tenants who now have multiple options across both new and existing properties. Affordability is another key factor. Tampa's rapid rent growth has outpaced local wage increases, limiting the pool of tenants who can comfortably afford market-rate housing. Many renters are opting for older or smaller units, moving further into the suburbs or even exploring surrounding counties. Insurance costs have also risen dramatically in Florida, driven by natural disaster risk and the state's unique regulatory environment. Property owners are facing higher operating costs at the same time that rents are softening. The combination of rising expenses, heightened competition, and an abundance of new units is squeezing landlord margins. The takeaway is clear. Tampa's rental market is correcting after an extraordinary growth cycle. While the metro's long-term prospects remain solid, population and job growth continue. Landlords are adjusting to a market that is far more tenant-friendly than it was just 2 years ago. Number 3. Charlotte. Charlotte has emerged as one of the Southeast's most dynamic real estate markets, attracting financial institutions, tech companies, and corporate headquarters. Over the past several years, the metro has experienced robust population growth, particularly among young professionals and families relocating from higher-cost states. This influx fueled strong rental demand, and for a period, Charlotte's rental market was one of the hottest in the country. Developers responded with significant multifamily expansion. High-rise urban developments and suburban complexes alike were delivered at a rapid pace. By 2022, Charlotte had one of the largest pipelines of recently completed and under-construction apartment units in the Southeast. However, that level of supply has begun to outpace local absorption. Vacancy rates are rising across many submarkets, especially in new luxury and high-amenity properties where competition is most intense. Advertised rents have flattened, and effective rents, accounting for concessions like free rent or discounted deposits, have started to decline in several areas. The dynamics in Charlotte are nuanced. While the city benefits from strong employment growth, particularly in banking, finance, and tech sectors, many of the new developments target a narrow demographic of renters willing to pay premium prices. When multiple luxury or Class A buildings open simultaneously, competition increases dramatically and pricing power shifts toward renters. Smaller and older properties are feeling secondary pressures as well. In a tenant-favored market, landlords of older stock often have to lower rents or offer concessions to avoid losing occupancy to newer, amenity-rich competitors. This ripple effect magnifies the market-wide rent softening. From an investment perspective, Charlotte presents both opportunity and caution. Properties purchased at peak valuations are seeing initial cash flow compression. Cap rates are slowly rising as buyers adjust for softer rent projections and the higher cost of debt. Long-term, Charlotte's growth fundamentals remain strong, but the current rental correction underscores the cyclical nature of high-growth markets. For tenants, the market offers leverage and choice. For landlords and investors, it demands strategic pricing, flexibility, and careful management of newly delivered assets. Charlotte is not in crisis, but is a clear example of a rapidly growing market entering a phase of moderation and recalibration. Number 2, Dallas. Dallas has been a powerhouse of rental demand for years, supported by strong population growth, a diversified economy, and continued corporate relocations. Tech, finance, healthcare, and logistics companies have contributed to job creation at a rapid pace, attracting professionals from across the country. At first glance, this appears to be a recipe for sustained rent growth, but even strong fundamentals can be challenged when supply outpaces absorption. The Dallas metro has experienced one of the largest multifamily construction waves in the country. Thousands of new units were delivered in urban centers like Uptown and Downtown, as well as in rapidly growing suburbs such as Plano, Frisco, and Richardson. The scale of development has created pockets of oversupply, particularly in Class A properties. The consequence is rising vacancy rates and softening effective rents. While headline rents may appear stable, concessions such as free months, flexible lease terms, and discounted application fees have returned in many submarkets. Class A units, once commanding premium pricing, are now competing for tenants against both newer developments and single-family rental homes operated by institutional investors. Dallas landlords also face pressure from increased operating costs. Property taxes, insurance, and maintenance expenses have climbed, compressing net operating income at a time when rent growth has slowed. Additionally, refinancing risk has emerged as many properties were acquired or developed under lower interest rate assumptions. Higher financing costs combined with softer rents create a challenging financial environment for owners. From an investment perspective, Dallas is entering a recalibration phase. Cap rates are gradually rising to reflect risk, and transaction activity has slowed as buyers and sellers reconcile valuation expectations with current market realities. Despite these short-term challenges, Dallas retains strong long-term fundamentals. Population growth continues, the job market remains robust, and corporate relocations persist. However, for the moment, the rental market has shifted decisively in favor of tenants, and landlords must compete aggressively to maintain occupancy and cash flow. Number 1. San Antonio. San Antonio tops this list due to the magnitude of its rent softening relative to local economic and demographic conditions. The city experienced significant multifamily development over the past several years, as developers anticipated spillover demand from booming Texas metros like Austin and Dallas. Yet, absorption has not kept pace with delivery, creating a structural imbalance in the rental market. Thousands of new units, from luxury urban apartments to suburban complexes, have been added in a short period. Vacancy rates have risen noticeably, and effective rents, including concessions for free months, waived fees, or upgraded amenities, are now well below peak levels in many areas. Even smaller, less competitive properties are facing pressure to maintain occupancy. Unlike Dallas or Austin, San Antonio does not have the same level of corporate relocation, driving rapid population inflows. While the metro has strong employment growth in healthcare, military, and services, these sectors cannot fully absorb the sheer volume of newly delivered rental units at premium pricing. This mismatch has shifted leverage sharply toward tenants. Operating costs are rising alongside these pressures. Property insurance, maintenance, and property taxes have all increased, further compressing landlord margins. For properties financed at peak valuations with lower interest rates, refinancing now represents a significant financial challenge. Landlords who relied on continued rapid rent growth for cash flow are having to adjust quickly. The rental correction in San Antonio highlights a broader lesson. Even in economically stable cities, rapid development combined with moderate demand growth can create significant pricing pressure. The market is not in crisis, but landlords are being forced to compete aggressively with concessions and flexible leasing structures, while tenants enjoy unprecedented negotiating power. Looking ahead, stabilization will require either a slowdown in new deliveries or acceleration in local demand. Until then, San Antonio represents the clearest example of a U.S. city where rents are collapsing and landlord pressure is most acute, a cautionary tale for developers, investors, and tenants alike. What we're witnessing is not a nationwide housing crash, but it is a decisive shift in momentum. In markets like Phoenix, Austin, and San Antonio, rapid construction, affordability ceilings, and moderated migration have combined to weaken landlord pricing power and push effective rents lower. Real estate is cyclical. When supply expands faster than sustainable demand, corrections are inevitable. The real question now is duration, how long absorption will take, how refinancing pressures will reshape ownership, and whether new construction meaningfully slows. If you found this breakdown valuable, like the video, subscribe to the channel, and turn on notifications so you don't miss future housing market updates. We focus on data, trends, and long-term implications, not headlines. The cycle is shifting. Stay informed.